Hello, everyone. What clears throat? I'm about to say sounds like a satire headline, the kind you'd scroll past and laugh at and then forget 5 seconds later. But this isn't satire. This is the kind of, are you kidding me? Moment that only shows up right before a market breaks. Because right now, a market that moves hundreds of billions of dollars in value is getting slammed. Not by a mine shutting down, not by a refinery explosion, not by a war in a producing country, but by a single political demand involving a frozen island in the North Atlantic. And that should scare you because it tells you how fragile the system really is. It is Sunday, January 18th, 2026. Most people are treating today like entertainment. They're watching the headlines, laughing at memes, listening to talking heads turn it into a late-night joke. He wants to buy Greenland again. Denmark says no. Is this real life? Everyone's giggling. Meanwhile, inside the Bullion world, the mood is not giggles, it's panic. Because hidden inside the Greenland drama is one sentence that rips the plumbing out of the Western silver market. A 10% tariff on imports from a list of European countries, including the United Kingdom, set to begin February 1st. And if the Greenland deal doesn't happen, that tariff threatens to jump to 25% on June 1st. To a normal person, that sounds like politics and posturing. To a risk manager at a major bullion bank, that sentence reads like a warning label on a live grenade. Now, before we go any further, I want to say this plainly. If the silver market can be destabilized by a tweet-sized policy threat, that tells you the system was already tight. And if the system is already tight, then even a small shock can behave like a big one. Hold that thought because this gets worse. Quickly, if you get value from these deep dives, support the campaign against the copycat channels that recycle research without doing the work. Subscribe and in the comments type OG John AG. That one line tells the algorithm you want original analysis, not copy-paste noise. All right, let's make sense of what's happening because once you understand the mechanism, you'll see why this isn't just news. This is structure. This is logistics. This is the hidden engine behind price. The global silver market runs on a simple assumption. An ounce is an ounce wherever it sits. A big wholesale bar in London is treated as interchangeable with a big wholesale bar in New York. Traders call this fungibility. It's a fancy way of saying the system pretends location doesn't matter. But in the real world, location always matters. The only reason the paper system can pretend location doesn't matter is because the big players can move metal between hubs whenever they need to. That flow is the oxygen. Without it, the system starts choking. And the two biggest hubs in the Western world are London and New York. London via the LBMA network is the center of the physical wholesale trade. New York via the COMEX structure is the center of futures pricing and paper leverage. For decades, the banks have played a game between these two hubs. When heat flares up in one place, they rush metal from the other place. Cool the fire and keep the illusion going. You've heard me call it whack-a-mole. Demand spikes in New York, fly bars in from London. London looks thin, pull bars from New York and send them across the ocean. The public sees price stability and thinks, wow, what a well-functioning market. The insiders know it's a juggling act. Now imagine you build a wall in the middle of that juggling act. That's what this tariff does. It's not about emotions, it's not about jokes, it's about math. If the United Kingdom is hit with a 10% tariff, then anything shipped from the UK into the United States carries a 10% cost penalty at the border. And London, by definition, is in the UK. So the LBMA ecosystem is now inside a tariff zone. Here's the nightmare scenario every banker is staring at today. If you are a bank with metal in the United States and you ship it to London to relieve pressure there, you might be saving London today. But what happens when you need that metal back in New York later to satisfy domestic delivery demand? The moment you bring it back, you pay the tariff. At $90 silver, a 10% tariff is $9 per ounce. That is not a fee. That is an executioner. It kills the arbitrage profit. It kills the swap economics. It kills the flexibility the system depends on. And if the tariff jumps to 25% later, that's not a cost. That's a full-on embargo in everything but name. So on Sunday, before markets even open, risk teams are already making calls. And those calls are simple. Stop moving metal. Because if you export silver out of the United States into a tariff jurisdiction, you are gambling that you'll never need it back. That is not a gamble any sane institution takes when inventories are tight. And inventories are tight. That's the part the meme crowd doesn't understand. This isn't happening in a world of overflowing vaults and casual excess supply. This is happening at the worst possible moment when London has been bleeding metal and the West has been leaning on shuffling and paper promises to keep things looking normal. So let's talk about London because London is the weak link. And London is where this story turns from interesting into historic. For years, the LBMA vault system has been losing physical silver to the East. India and China have been vacuuming up metal not because they're bored, but because they view physical metal as strategic inventory. They take bars, they reallocate, they refine, they store, they use. They don't play the same paper game. When they buy, the metal leaves. That drain has pushed London inventories down to levels that make insiders uncomfortable. Even worse, a lot of what remains is spoken for. It's tied up in ETFs, leased positions, unallocated balances, and other claims. The amount of truly free, unencumbered, deliverable metal is the part nobody likes to talk about out loud. Now add the tariff wall. If New York can't comfortably send metal to London and later retrieve it, then London loses its emergency supply line. It becomes a besieged city. And in commodity markets, when a hub is besieged, prices stop being global and start being local. That's the beginning of a split market. And here's where it gets interesting. The moment traders realize metal can't move freely, the price is no longer one price. You can have a New York price and a London price at the same time. The law of one price dies not because someone changed physics, but because someone changed policy. If that sounds crazy, ask yourself this. We never lived in a world where global trade was frictionless. We lived through a 30-year stretch where the costs were low enough that people pretended borders didn't matter. Now borders matter again. So here's what a split market looks like. It looks like this. Silver trading at one level in New York and at a higher level in London. Simply because London can't source metal to meet delivery demands, and because the tariff blocks arbitrage, the spread can't be instantly closed by the banks. That's terrifying for the banks because their books are built on the assumption that spreads don't blow out. Their models assume they can hedge London exposure with New York exposure. In a normal environment, that's fine. But if London goes to a premium, the hedge breaks and suddenly hedge positions become directional losses. Now, let's get more specific because this is where the mechanics matter. There's a concept traders use called a location swap. Instead of physically moving bars instantly, a bank can swap ownership claims. I'll give you title to bars in New York. You give me title to bars in London. That helps balance books without immediately paying shipping and insurance costs. But here's the catch. Location swaps work because everyone believes the metal can be moved later if needed. It's like chess players who assume the board will still exist next turn. A tariff introduces a permanent penalty. It turns a flexible situation into a trap. You know the Roach Motel slogan, roaches check in, but they don't check out. That's what a tariff does to metal in a trade war environment. Metal can come into a country, but once it's inside, moving it back out and then back in again becomes economically painful. So the metal stays put, it gets hoarded. And yes, that means the United States starts acting like a one-way valve. If you're a domestic industrial consumer, that can be bullish for supply security. If you are London trying to survive on imported liquidity, that can be lethal. Now here's where most people miss the plot. They think, if silver is trapped in the US, doesn't that increase supply here and push price down? That sounds logical until you remember the market isn't just physical. It's a complex web of paper promises, hedges, and confidence. When confidence breaks, price doesn't follow supply. Price follows panic. If London begins to show signs of strain, the immediate reaction in New York won't necessarily be a crash. It can be a bid, because banks and funds rush to rebalance exposures. Shorts that were comfortable become terrifying. Everyone wants to be less short, more long, more protected. In other words, the moment London looks like it might crack, the reflex is to buy protection in New York. And that buying pressure can lift prices, not lower them. So the tariff doesn't just change flow, it changes psychology, it changes risk. And risk is what moves markets. Now, you might be wondering, is this really enough to kill the silver market? The answer depends on how tight the physical is and how aggressively the paper system was leaning on easy logistics to keep the game going, which is why the timing matters. If this happened in a year when London was overflowing with deliverable silver, the banks could shrug and say, fine, we'll live with the cost. But that's not the year we're in. We're in a year where people are watching vault data, seeing drawdowns, seeing demand, seeing stress, and asking uncomfortable questions. Now the system gets hit with a tariff wedge that breaks the circuit between the two major hubs. This is what black swans look like. Not an asteroid, not aliens, a mundane policy change that nobody modeled for, arriving at the worst possible moment. And I want to pause here and point something out. Algorithms are not built for this. The trading bots are trained on macro variables, interest rates, the dollar, industrial indicators, maybe a few sentiment feeds. They are not trained to quantify the consequences of a geopolitical real estate dispute on Bullion logistics. That's why humans still matter. That's why you're listening to a human voice right now. Because the machine sees tariffs, the machine sees trade dispute, the machine sees noise, but the human sees pipeline rupture. Now, let me slow down and make this painfully concrete. Because if you've never worked in shipping or commodities, the danger can feel invisible. A wholesale silver bar is not a Spotify song. You can't just stream it from one market to another. You have to book transport, insurance, chain of custody, customs paperwork, assay verification, and vaulting on the other end. That's why the whole system depended on the idea that once you paid those costs, you weren't going to get hit with a surprise extra tax that turns the whole trip into a loss. Tariffs do exactly that. They add a variable that sits outside the trader model, and traders hate variables they can't hedge. Think about what a tariff really is. It's not just a government collecting money. It's the government saying, this border matters again. And when borders matter, the world stops being one market and becomes a collection of smaller markets with friction between them. That friction is what breaks paper pricing. Here's a simple example. A bank sees silver at $90 in New York and 98 in London. In a frictionless world, that's a gift. They'd buy in New York, sell in London, and close the spread. But now, if they expect that metal might have to travel back later, that spread isn't $8 anymore. It's $8 minus shipping, minus insurance, minus financing, minus vault fees, minus the tariff risk. And the tariff risk is the killer because it's not a one-time cost. It's a potential future penalty that hangs over every decision. So the bank does nothing. The spread stays, the spread grows, and the public thinks, why is silver suddenly behaving like a closed market? Because it is. Now, I want to add one more uncomfortable angle. This isn't just about London being short. It's about trust in the settlement chain. If you're a large buyer in Europe and you usually source through London, what do you do when you hear the US supply line is questionable? You don't wait to find out. You pull forward purchases. You lock in supply. You demand more allocated metal, and that behavior itself creates the shortage. And here's the part that should make you sit up. The tariff isn't even live yet. February 1st is the date, but markets don't wait for the calendar. They move on expectation. If you're a vault operator or a refiner and you have shipments planned, you reroute now. If you're a bank, you adjust now. If you're an industrial buyer, you lock now. So the effect starts before the policy starts. Now let's talk about the retail side for a second, because this is where a lot of you feel like you're being gaslit. You look at the screen, spot says one number, you go to buy, and the real price is higher. You ask why, and people shrug. They blame premiums, they blame dealer greed, they blame demand. But in stress events, premiums are not greed. Premiums are the market telling you the screen price is missing costs and risks. Tariffs add risk, logistics add risk, and risk shows up first in premiums. So if you see premiums widening, don't just get angry, get curious, ask, the market is pricing something in that the screen is ignoring. And while you're at it, here's a practical engagement request. Tell us what you're seeing in your area right now. Higher premiums, longer shipping times, tighter inventory. The fastest way to map a real shortage is thousands of people reporting the physical reality from different locations. Now, we also have to talk about premiums again, because I know that's what you feel immediately. If replacement cost rises due to tariffs and constrained logistics, premiums rise. That means your stack becomes more valuable in terms of replacement cost, even if spot doesn't move. That also means new buyers pay more. That discourages marginal demand until fear overrides price. That's how parabolic moves happen. People resist, 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 then panic. Now, I'm going to give you a practical mental model that helps you navigate the chaos. Stop thinking of silver as one market. Think of it as 3 layers. Layer 1, paper price on screens. Layer 2, wholesale physical between hubs. Layer 3, retail physical in your hand. In calm times, those layers track each other. In stress times, they decouple. And when they decouple, the truth is in layer 3. The tariff attack is aimed at layer 2. It disrupts wholesale flow. That disruption bleeds into layer 3. Layer 1 will try to pretend nothing happened until it can't. That's why this is a retention story. The real action won't always show in the first candle. It will show in the delays, the spreads, the premiums, and the rule changes. Now, I want to tease what comes next, because this is not the end of the story. This is the first chapter. If tariffs trap metal, countries will start competing to trap more. If that happens, the era of global price ends. The era of regional premiums begins. And if regional premiums become permanent, then the nominal price must adjust upward over time to reconcile shortages, incentivize supply, and reflect geopolitical risk. And that's when you get what people call the repricing. But before we talk repricing, we need to talk about the people who will try to stop it. The same institutions that benefited from the old system will fight to keep it alive. They will fight with narratives. They will fight with volatility. They will fight with fear. So here's what I need from you. Stay calm, stay informed, and watch physical reality. And yes, subscribe, because these next few weeks are going to be insane. Now, Another quick note, check the description. I've left bonus links there for you, including a premium WhatsApp channel link and a way to join the channel membership. And yes, we're also offering members-only videos where a separate team goes deeper, does extra research, and builds premium reports that we don't publish publicly. All right, back to the core story. Monday morning is where this becomes real. Because on Monday, London wakes up and realizes it can't rely on New York the same way. And London is already tight. So this is what happens. You get a scramble. You get a run on unallocated accounts. This is another part of the market that most people don't understand. A huge chunk of silver ownership in London is not actual bars. It's unallocated claims. Basically, IUS from banks. It works like fractional reserve banking. Many claims, fewer bars. It runs fine as long as nobody demands delivery. But when trust drops, people demand delivery. And the moment London traders smell supply line cut, the first thing they do is they call their bank and say, convert my unallocated balance to allocated bars. Here's the problem. If too many people do that at once, the system can't deliver. And when a delivery system can't deliver, it has only a few options. Delay, settle in cash, or pay a premium to source metal. Delays erode confidence. Cash settlement exposes the paper nature of the market. Premium bids push price up. None of those options are friendly to the banks. And if the banks are already short metal, the situation becomes even more violent. This is how a liquidity problem becomes a solveny problem. That's the phrase you need to remember. Liquidity becomes solveny. It happens fast. It happens when everyone realizes the exit door is smaller than the crowd. Now, let's bring in the trapped inventory idea again because it's critical. If the United States becomes a roach motel for silver, then metal in the US becomes strategic. It becomes desirable because it's inside the jurisdiction, inside the supply chain, inside the industrial base. And if you're a domestic manufacturer, you care less about London paper price and more about whether you can secure physical inputs without betting on cross-border shipping. So the tariff could ironically increase domestic hoarding. Banks hoard, industry hoards, investors hoard, everyone hoards, and hoarding is how shortages become visible. Now, I can already hear someone saying, but the government didn't intend this. It was about Greenland. Exactly. That's why it's dangerous. Consequences are the most destabilizing ones because nobody has a clean plan to manage them. This policy, intended or not, changes the incentives for metal movement. It makes exporting and re-importing financially toxic. That's a structural change. And structural changes don't reverse overnight. Now, here's the cliffhanger that matters most. If London can't source enough physical metal to settle, then the global pricing system starts losing legitimacy. Because, like it or not, the Western market has been built on the idea that paper pricing is the price. The LBMA and comics together create the reference that the world uses. But if the physical market in London breaks, that reference loses legitimacy. At that point, the real price becomes the price where delivery happens. And if the West can't deliver, then the East becomes the price setter. Shanghai becomes the anchor. And if you think that doesn't matter, remember, the East does not price metal the way the West does. They price it with tighter ties to physical. They tolerate less leverage. They don't have the same appetite for infinite paper. So a shift in price setting power can mean a repricing event, not a gradual drift. Now, before I continue, let me drop something in creatively because a lot of you are here for silver, but some of you also love hearing how regular people turn these trends into real results. If you want silver-related success stories, real examples of how people positioned early and did well, there's a link in the description to a separate channel that focuses on those stories. Go subscribe over there too and see how people have actually made money step by step. All right, back to the market. Let's talk about spreads because this is where the charts will start screaming. In normal times, if London trades higher than New York, banks arbitrage, buy in New York, ship or swap to London, sell in London, collect the spread. That activity narrows the spread quickly. That's why prices stay aligned. But with a tariff wedge, the spread can persist. The cost of closing it is too high. That's when you get segmentation. Segmentation means you can't trust your screen. It means the global spot is an average of broken markets. It means if you own a paper product that references spot, you might be holding something that doesn't track the reality of physical acquisition. That is the core risk. If you're a physical holder, segmentation can be bullish. If you're a paper holder, segmentation can be a trap. Now let's bring it to you because I don't want this to be abstract. If you go to buy physical silver and you notice premiums jumping, that's the tariff effect and the logistics effect bleeding into retail. If you see dealers quoting longer delivery times, that's stress. If you see out of stock banners, that's stress. And if you see mainstream media still laughing about Greenland while those signals show up, that's your tell. That's your opportunity because the crowd laughs right before the stampede. Now, here is the part the banks hate the most. Once logistical friction is introduced, suppressing price becomes harder. Suppression, if you believe it exists, requires flexibility. It requires the ability to source metal when delivery pressure builds and to shuffle metal between hubs to cool panic. It requires confidence in the plumbing. Tariffs clog plumbing. And when plumbing clogs, pressure builds. So if you're wondering why something as simple as a tariff matters, that's why. It doesn't just add cost, it adds friction. And friction in a leveraged system is explosive. Now we have to address one more layer, industrial demand. Silver isn't just a shiny rock people stack in safes. It's an industrial input for electronics, solar, defense, medicine, and more. If domestic supply becomes strategically important, you can see policy support shift. You can see buyers step in earlier. You can see government procurement. You can see corporate hoarding. That's why a tariff can accidentally function like a national stockpile policy, and again, unintended consequences. Now let's talk about the timing of the tariff schedule because markets will front to run it. February 1st is the initial 10% tariff start date. June 1st is the threatened escalation to 25% if the Greenland negotiation fails. Even if those dates shift, the key is that the market now has a timeline. Traders hate timelines because they create cliffs and cliffs create front running. Nobody wants to be the last buyer before a wall goes up. So you can see behavior change immediately. You can see shipping decisions change immediately. You can see hedge decisions change immediately. And the moment those decisions change, flows change. And when flows change, price follows. Now, what do I expect the banks to do? They'll try to confuse you. They'll try to spin it as temporary. They'll try to say it's already priced in. They'll try to distract you with something else. They'll publish stories about how much silver exists in theory. They'll highlight a warehouse ad here, a paper statistic there. But in tight markets, the marginal bar matters, not the headline inventory number. And the marginal bar is the one that can move from one hub to another at the exact moment it's needed. Tariffs attack the marginal bar. Now, I want to ask you a question, and I want you to answer it in the comments because I read them and they shape what we cover next. Do you think this tariff pressure is a short-term headline shock? Or do you think it's the first sign of a longer resource nationalism cycle where every country locks down critical materials? That question matters because the answer determines whether this is a spike or a regime change. Now, I also want to say something friendly. If you're one of the people who's been doing well, maybe you started stacking earlier, maybe you positioned into metals or miners, maybe you protected yourself and it paid off. Share your success story in the comments, not to brag, but to motivate people who are still on the fence. Your story helps someone else stay disciplined. All right, let's push deeper into London because that's where the fuse is lit. If London can't access US metal easily, London must source elsewhere. Europe is already on the tariff list. Asia is absorbing supply. Mine supply is not flexible. Refining takes time. Shipping takes time. In other words, London cannot solve this quickly. So what does London do in a crisis? It delays. It offers cash settlement. It encourages rollovers. It tweaks rules. It changes contract language. It does what exchanges always do when reality doesn't match the paper promises. And every time they do that, confidence drops further. Now, here's a scenario I want you to consider because it's the one that ends up on history pages. Imagine London starts settling in cash because it can't source metal fast enough. That would be framed as normal. They'll call it liquidity management. They'll say it's standard practice, but the market will hear something else. They didn't have the metal. And once that thought enters the bloodstream, it doesn't leave